Welcome to London Property News Bulletin. Every week, we break down the key headlines and the wider news that could influence the market, keeping you informed and confident in your decisions. Here is what you need to know this week.
Landlord sales remain most concentrated in London and the South, where higher prices, thinner yields, and elevated mortgage costs have squeezed investor returns hardest, Hampton's data shows. In the capital, 1 in 5 homes listed for sale in June had previously been let within the past 5 years, more than double the Southeast's 9.5%. Northern markets, with stronger yields, recorded the smallest falls. For prime London owners, the signal is clear. The buy-to-let model no longer works where capital, not income, drives value. According to The Times, 1 in 7 UK households now holds a net worth of £1 million or more, a figure that makes a wealth tax tempting to a treasury hunting for revenue. The problem is liquidity. Most of that wealth sits in homes and pensions, not cash, so an annual levy on paper value could force sales rather than release funds. For prime London owners whose worth is overwhelmingly bricks and mortar, it is a timely reminder that asset-rich is not the same as able to pay. A UAE-based ultra-high net worth family has secured a £24.4 million loan against a 16,300 square feet freehold residence in Belgravia, arranged by Solzakai's Topland Vintage. The 18-month facility, at 60% loan-to-value, refinanced an existing private bank loan and was funded from Topland's own balance sheet. Introduced by Mantra Group, it signals continued conviction in prime central London debt even as the sales market softens. The takeaway? At the very top, Gulf money is still deploying increasingly through bespoke private lending rather than the high street. Prime rents rose again in the second quarter, with outer prime London up 1.2% and prime central London a steadier 0.4%, Savills reports. Landlords are reassessing rents to offset higher mortgage costs and a heavier tax burden, while the Renters' Rights Act pushes more stock into the sales market and tightens supply. Homes within the Act's scope lower value lets are outperforming, rising 2.7% over the year against 1.7% above the threshold. Scarcity, not exuberance, is doing the work at the top of the market. Leaseholders will gain clearer information on service charges and stronger protection against unfair costs under the Leasehold and Freehold Reform Act, the government has confirmed. A standardised demand form, an annual budget, and a report on building condition and planned major works are all promised, alongside a right to challenge charges without funding the landlord's legal bills, closing a loophole that left some flat owners paying up to £60,000. Most measures land from 2027. For prime London leaseholders, long opaque charges finally face daylight. Too many sellers are still pricing as though it were the 2021-22 boom, and buyers are simply ignoring the inflated asking prices, This Is Money reports, citing On the Market's Jason Tebb. Realistic pricing is now the difference between a sale and a stale listing, with over-optimistic homes sitting unsold and handing negotiating power to buyers. In prime London, where discretionary vendors can afford to wait, the gap between hope and achievable value is widest of all, and the market rewards those who price to today, not yesterday.
That wraps this week's London Property News Bulletin. Thank you for listening. If something caught your attention or you need support navigating the impact of the news, then please reach out to us. We're here to guide you. If this was useful, do pass it on to someone who also follows the market, and don't forget to subscribe to stay one step ahead.